We're going to continue our discussion of some items that are either included or excluded from gross income. Remember, this is not an all-inclusive list. Our brains would burst if we tried to cover it all. So as you go through this, remember that you do not know everything you need to know about tax, and you need to be very careful about giving people tax advice. So I'm just going to list several things that are also included primarily in Chapter 5, but also you can find them in Chapter 4 that talk about inclusions or exclusions. Rental income, pretty similar to GAAP, but there are a couple of things I want to make sure you're aware of. Discharge of debt, a little bit of a tricky area. We're going to talk about it in general. You may need to look at the examples in the book. Annuities, very complicated. You'll want to make sure you spend some time on annuities before you come in to take the related mini test. Alimony, relatively straightforward. Some quirks, and we'll talk about those. And now we have a list of things that are getting more and more like laundry list. This, that. Awards, prizes, and gambling, almost always income, a couple of exceptions. And then we'll talk about other exclusions. These will include things like your fringe benefits and life insurance, gifts, those kinds of things. And then we'll talk about legal settlement. The most important thing about rental income is that the timing is different than GAAP. For the landlord, there is no such thing as unearned income. Remember, if I got the money, I got the tax. So landlords essentially are all forced into a cash basis position. The tenants go the other way. They're basically forced into an accrual-based position so that even though they've paid it, they won't get a deduction until they will have actually used it. So if the tenant pays the landlord $10,000 covering first and last year's rent, the landlord pays taxes on it all. The tenant gets a current deduction of $5,000. It will not get that other $5,000 until the last year. 10 years, 15 years, 20 years down the line, that's how long it'll take for the tenant to get the deduction. Tenant improvements, that is the renter making physical changes to the building. The leaseor, that's the person who owns the building, has rental income up to the market value of the improvements, the new walls, the new paint, the repairs. If it is in lieu of or in place of rent, I tell you what, the place really needs to be painted. I'll paint it and you will forgive me my month's rent. So remember, substance over form. The renter paints the building is the same as the renter pays the rent and the landlord buys him the paint to paint in the building. Or if the repairs were the responsibility of the leaseor. You were supposed to fix the plumbing. You didn't. You dug in your heels and did not get it done. I break down and pay for it myself. You have rental income. On the other way, all other payments would be not taxable. So you, the renter, decide that you'd really like partitions. The building was recently painted, and you decide it's got to be a lovely lime yellow instead of the color it currently is. Those improvements would not create income to the landowner. In some cases, it will increase the fair market value of the property. The way that is accounted for is if you, the renter, made the building better, if I can sell it for more, I'll have a higher sales price without any change in my basis. And basis is a topic that we will discuss towards the end of the course. Discharge of debt or indebtedness is an area that does cause students some problems. There are examples. What I have found is you're simply not reading the examples carefully. A second thing is that the book will talk about a gratuitous release of debt. Someone makes a gift to you of the debt that you owe them. This is not a business transaction, right? This is grandma letting Junior off the hook for the car loan that she took out. We are talking about business-related transactions. And so in that case, there are only two situations where the forgiveness of debt is not included in gross income. The first is Chapter 11 bankruptcy. So if you engage in formal bankruptcy, and not all bankruptcies are Chapter 11, so in the real world, you need to be careful about that. You would not have an income recognition event. And then this next bullet simply says that if you were supposed to pay $2 million for the building and you land up being released of a $500,000 worth of that price, the price of the building, the basis to you has to drop down by that $500,000 because you can't have a tax basis for certain things you haven't paid and provide a tax benefit in the future. With buildings, we're going to see you recover the cost with depreciation. So you're not going to be able to depreciate that $500,000. But that's an area that is a little more complex than what we need to be. So you need to know that if I say the debt was discharged in a Chapter 11 bankruptcy, there is no income inclusion. The second is a little bit more complicated, and this is the one where the problems in the book need to be read carefully. Right? So insolvent means that you owe more than the fair market value of your assets, but you're not filing for bankruptcy. Right? So the bank decides that if they rewrite your debt, there's been a lot of discussion about that for taxpayers who are underwater on their homes. We'll lower the amount of the money that you owe us because we believe that the house has a $2 million loan. It's only worth $500,000. If you walk away from that loan, which you could do in bankruptcy, then what do I have? I get absolutely nothing. So the bankers have some incentive to, all right, so let's reduce the amount of the loan or adjust the interest rate so that you're more likely to pay me at least some of the money that you owe me. Because remember, I get the house back. I can't sell it for the amount of the loan because if I could, the owner would have done that to protect their credit. So you have to measure whether or not they are still solvent. That definition is insolvency is liabilities are greater than the assets immediately prior to the discharge. And the second bullet here says limited to the amount by which a taxpayer is insolvent. So your first test is to determine how much they're insolvent and then how much debt relief was given. So look at those examples carefully. You are likely to see them in either a group or mini test. Annuities are extremely complicated. We're going to do a very simple example here. I would suggest that you look at all the permutations that are in the chapter and you make sure that you are comfortable knowing where the tables and the numbers are coming from so that when you get the chance, which you will, to replicate one of these examples in Blackboard or group quizzes or mini quizzes, mini tests, you will not have to waste a lot of valuable time. So an annuity is simply a self-liquidating investment. The most traditional kinds of payments received as annuity are retirement payments. You might have a traditional defined benefit pension plan, and your employer has it promised you X dollars per month for as long as you live. Or you may have a 401k, and you're going to take what you have in that 401k, and you're going to invest it. And each year, you're going to take out a certain amount of principal and interest. Another common form of annuity is you give an insurance company a certain amount of money, and they promise to pay you back another amount, either $20,000 a year for the rest of your life or $20,000 a year for 20 years. Each payment will be a combination of your money coming back to you and earnings. So only a portion of each payment is considered income. If you're still unfamiliar with this, another way to think of an annuity, if you win $1 million in a sweepstake, you're going to get $50,000 a year for 20 years. And that does indeed add up to $1 million. But if you try to cash out, the state's going to give you something significantly less than that. Because what the state does, the way they make money on the lottery is instead of putting $1 million in the bank and giving it to you $50,000 a year, they broker with an insurance company. They give the insurance company $450,000, $600,000, depending on the interest rates. And then the state gets to walk away from this annuity. And then it's the life insurance company's job to make sure that they generate enough earnings so that each payment that you get, each $50,000, is part of the money the state gave you. And the rest of it is monies that the insurance company has earned by keeping your money. So we'll be just doing something quite similar to that, only instead of winning the money, we're simply going to have money that we own and we're going to purchase an annuity. So the payment that we get back is classified in two parts. The first is our non-taxable return of investment. what you actually paid to the insurance company or other annuity provider. And a concept we haven't discussed, but we will quite intensively at the end, is return of capital. There's a tax principle that says when you spend money to make money, you have the right to get that money back tax-free. So you don't have to pay taxes on your principal. What's left will be the taxable gain on your investment. I use the word gain, but remember this is ordinary income, taxed at your highest marginal tax rate. So you're going to determine how much you get to exclude by calculating an exclusion ratio. And that's going to be the investment in contract, what you actually paid, divided by your known or expected return. You have a known return when the annuity has a set period of time. You're going to get $20,000 a year for 10 years, and then it disappears. Or here, $5,000 per year for 10 years. Expected return are lifetime payments. And when you decide to buy a lifetime annuity, you could be a very healthy 65-year-old, or you could be a problematic 65-year-old. But the insurance company doesn't get to guess how long you're going to live. Instead, they have to look up a multiple. They have to determine how many years the IRS says you're going to live. So the IRS has actuarial tables that say that the average 65-year-old person will live so long. All right, so it's simply tables that actuaries have put together. And then the way this gets really complicated is you can have joint and survivor features that get very complicated. So my husband has a defined benefit pension plan, God bless him. He has a joint and survivor feature, which means that we are collecting right now less per year than we could have. But the survivor feature means that if he dies, I continue to collect benefits. So it's his, so jointly we get money. If he should pass, I would continue to get a smaller sum. I'm 12 years younger than him, so presumably I have the odds of living longer than him. And so we decided to settle for less upfront to make the money last longer. So joint means we both get the money. Survivor means that one of us will continue to get paid. And there are all sorts of variations of this. And so I strongly suggest that you look through the examples in the book and try some of the homework. So the amount that gets excluded from gross income is simply the amount you get times the exclusion ratio. The exclusion ratio is simply the investment in the contract, what you paid, divided by either the known 5 years or expected, they think you're going to live 16 years, return under the contract. So we got an example here, and this is a simple annuity. I'm single. I'm going to get paid for my life. When I die, everything disappears. So the first step is to know what we're doing, right? John is 70 years old. We need that to get to the right row on the right annuity table. And he paid $19,000. That's his investment in the contract. He's going to get $150 per month for life. All the problems tend to give you the per month for life. I think the reason for that is that most annuities originally start in the middle of a year, but all you're going to do is convert the $50 per month to a total for the year, and that's just wasted energy on your part, right? So I tend to give you the annual payments, but in the book, it will simply take the monthly payments and multiply by 12. It's not using any complicated examples where you started in August. So where it says per month times 12, just read that as your annual payment and leave one step of the math out. So step 1, compute the expected return. I have to look up and see how many years John is going to live if he is currently age 70. And that will come from one of the tables. And then we will multiply by the 150 times 12. So the multiplier, table 2, it's a straightforward, simple annuity with no bells and whistles. You would go down to row for 70, and you would read the number, and you'd be in good shape. And the amount of the annual payment is $1,800, 150 times 12. And now all you're going to do is multiply. So your expected return is $28,800, simply by doing the math. Second step is to compute the exclusion ratio. The exclusion ratio is what you paid divided by your known or expected return. All right, so it's simply 66%. I paid 19, My expected return is 28.8. Step 3 is simply to compute the amount excluded or to compute the amount included. I have been known to ask sometimes for included, sometimes for excluded. Make sure you pay attention to what's in front of the word "clude" so that you're either excluding or including. So it's simply the total you got this year times the exclusion ratio. All right, so I got 1,800. My exclusion ratio is 66%. So I get to exclude or leave out of gross income 1,188, which means I would include in gross income what's left. Alimony is a great example of how tax planning can change results. It is also another example of bracket shifting. Hopefully, as we work through tax returns 1 and 2, I talked to you about one of the reasons why Thelma's income taxes are so much higher in tax return 2 compared to adding up the corporate and individual liabilities in tax return 1 is because she has 2 different taxpayers who are splitting the income and shifting income that would have been taxed at the highest brackets into the lowest brackets of the second entity. So alimony has a couple exercises here. The first thing is important to understand what alimony is and why we get the tax benefit. All right, so if a payment to an ex-spouse is properly made, it will be income to the recipient and a tax deduction to the person writing the check. So if a person in a 35% tax bracket can push $1,000 out of their income tax and taxable income into someone with a 10%, the savings is the difference between the two tax rates, and that could be significant. So only alimony if a written divorce decree, so that's very important. You've got to go to court. You got to get a judge to bang his gavel and say you are officially divorced. The decree cannot preclude alimony. What that means is if you want to make absolutely sure that there's no way that the payments your ex are making to you would be included in your income, you simply write into the divorce decree, no payments will be deemed to be treated as alimony. And then later, if your ex says, oh, that was alimony, I'm taking a tax deduction, if your return is audited, the IRS will say, why did you not include the alimony in income? And you can say, well, see, it was never supposed to be. Go back and get the money from the other guy. You can't live together. A great tax dodge. We'll talk a little bit later on about marriage bonuses and marriage penalties. It has been done repeatedly where people in high marginal tax rates will get a divorce. So that what can they do? They can shift the income from the individual earning all the income in the higher tax brackets to the person in the non-working spouse with the zero and low tax brackets. But they really didn't want to get a divorce. All they wanted to do was reduce their taxes. So if you share the same address, whether or not you share the same bed, payments between you cannot be treated as alimony and not child support. So we'll differentiate shortly between alimony and child support. So alimony is income to the payee, the person writing the check, and a deduction for AGI by the payer. Now, as we go through the rest of this part of the course and into part 2, remember that adjusted gross income is an important number. It's the last number on the front of the Form 1040. So to have a deduction on the front page is a good thing in many ways, and we'll talk about that again as we go. So both of these are on the front of the 1040. So one person has alimony income and the other one has an alimony deduction. For payments to be treated as alimony, they actually have to be made in cash. What this means is you cannot just let your ex use your house or your car, but it doesn't mean that you absolutely have to give the ex the cash directly. So your ex is just not very good at managing money. Rather than giving him cash directly, you could pay the mortgage payments directly from your bank account to the mortgage company, and that would be deemed to be paid in cash. They must terminate with the death of the payee. The payee is the person getting the check. So we're going to have alimony, child support, property settlements. They all have different tax consequences. And sometimes someone will want something to continue after death and be treated as alimony, and that simply doesn't happen. On the other hand, if you want to front load, or not front load because that's a technical term, but if you want to have all of the payments for child support, property settlements, and alimony to be treated as alimony, So the taxpayer with the higher tax bracket gets the bigger deduction. You have to terminate with the death of the payee. So what that means, if you were planning on getting $1 million, $200,000 a year, and you die in year 3, the X will not make the payments for year 4 and 5. So if you were planning on that being money to go to your children, you're just out of luck. Or more importantly, they're out of luck, right? So if you do want to do that kind of fancy tax planning, it's always encouraged that you go ahead and make part of the alimony. The X with the higher marginal tax rate will also buy a insurance policy that will cover the difference, the payments that haven't come out yet, with the children as the beneficiary. Because you've all heard of the horror stories where he marries that sweet young thing, they have a brand new baby, and all of a sudden your scraggly old teenagers aren't very attractive, and they tend to get the short end of the stick. So a really good divorce lawyer will understand all these things, and they will make sure that you're not taking a tax deduction and leaving yourself short for some other negative consequences. Recapture, we're not doing that at all. There's some math in the book, but we're just going to ignore it completely. So definitely not on the test. We got plenty of stuff to worry about.